Hello everyone, welcome to this morning's webinar. I hope you will enjoy learning about payroll taxes. Please mute yourself in order to cancel any background noises. At the end of the webinar, there will be a chance for you to ask questions, and you may also use the chat feature. And at that time, you can unmute yourself. Okay, my name is Amy Skloot, and I work at Excel HR. I have been working in the payroll tax department for 18 years. That is a long time to stay in the same department and same company. However, it does not feel the same. I'm constantly learning something new, and the industry is constantly changing. When I first started, most of the tax returns were filed by paper. I printed them out and manually completed them and put them in the mail with the check. Then as the years went by, one by one, the states changed to electronic filing. This has been a good change for the security of the employees' data and in order to get the taxes to the states quicker and more accurately. In the past, we relied on the postman to get our tax returns to the state and for the states to open the mail and post our checks and tax returns properly. You can imagine all the problems and errors this caused relying on all these factors. The notices never ended. However, now, since we're able to make the payments online, upload files, and then we get confirmations on the spot. Then if there are any issues, we can review our payment history and even appeal notices directly on the state's website. Although it is nice to have everything online, it puts more pressure on the employer to make sure the taxes are filed accurately and on time, because you can no longer blame the mailman or employees of the state for issues. In this webinar, I will discuss the following taxes: unemployment, withholding, local and federal taxes. In addition, I will discuss W-2s and new state laws and regulations. First, I will talk about state withholding tax. What is state withholding? This is the tax that is withheld from your paycheck and is calculated based on a tax table from the state, or sometimes a flat amount. How do you know how much to withhold? Well, the employee completes a W-4 form and enters an amount that you would like to withhold, and this is called exemptions. There are 9 states that have no withholding tax. Alaska and Florida are 2 of them, and those states you would not have to file state withholding taxes. And there are a few states that use the federal W-4 form for the employees, such as Colorado and Minnesota. However, this will be changing soon because this federal W-4 form is changing drastically, and we'll discuss that a little more later. How do you determine what state to withhold the taxes from on your employees? Well, you must decide where they live and where they work, and then know if these states have reciprocity with each other if they live and work in a different state. So reciprocity is when the states have an agreement with each other to withhold only from where the employee resides. For example, Maryland and Virginia, they have reciprocity. So if you live in Maryland but work in Virginia, you would only need to withhold the Maryland state taxes. However, if you live in New Jersey but work in New York, these states do not have reciprocity, and you would have to withhold both state taxes for both states. So it's very important to know where the employees live and work in order to withhold the proper amount of taxes in the proper state. We had a client once get a notice from North Carolina. Now, North Carolina has no reciprocity with other states. So if the employee works there, you would have to withhold taxes there. Well, they had a work site in North Carolina and reported that work site on their corporate tax return to the state. However, there was no W-2s to match those wages that were earned in the state. So the state of North Carolina asked the employer to send them the amount of tax that should have been withheld, because they said the employer would be liable for those taxes since they were not withheld. The employer gathered the information, and the state determined in the end it wasn't enough tax for them to collect locally for the client. But in the end, the client now is very sure to let us know where their employees work so that the proper taxes are withheld. So they no longer get notices from another state. Next, it is important to file the taxes properly. The states have several filing frequencies, such as semi-weekly, monthly, quarterly, and annually. And you get the frequency based on how much tax you withhold total for the state. And the more taxes you withhold, the more frequently you should pay these to the states. And if you do not pay on time, you can incur significant penalties. For example, in Georgia, if you do not pay the tax on time, you can get anywhere from a 5% penalty to 25% penalty on the tax paid late. So you must know when your filing frequencies are and pay them on time. If you have a semi-weekly filing frequency, this means that a paycheck on a Friday would now need to be paid to the state by the next Wednesday. They want their money more frequently because you have withheld a lot of money. There are also requirements for filing reconciliations. This is when you match the tax payments to the liabilities for a specific period of time. There are different frequencies to file the reconciliations. Some states want them monthly, some quarterly. And not all states require reconciliations, but the ones that do can also charge you a penalty for not getting those to them on time. Next, all states that have a withholding tax also require you to file annual reconciliation. Annual reconciliation is when you upload your W-2s to the state, and the tax on those W-2s must match the tax payments that you made for the year to the state. And if you underpaid for the year, you must reconcile or pay the additional amount of tax due. These W-2s are due to the state by January 31st of each year. And if you don't get it to them on time, there can also be significant penalties. For example, in Utah, for a late W-2, you can have anywhere from a $30 penalty for each W-2 not filed up to $100 penalty for each W-2 not filed, which can get you a penalty of $500,000. You definitely want to make sure you upload those W-2s on time to the states. We used to have until February 28th of each year to get the W-2s to the state, but due to a lot of fraud and employees getting refunds inaccurately, the states have now asked us to submit the W-2s at an earlier date to avoid fraud and ensure that employees' refunds are processed correctly. But this has added a lot of pressure to employers to get the W-2s at an earlier date. We used to have a whole month to get those on time. Next, we have local taxes. Local tax withholding can be the most complicated and troublesome tax type. There are 23 states with local taxes. In Pennsylvania, there are 3,000 jurisdictions that you can pay taxes to, and you must know where the employee lives and works to withhold the correct jurisdiction taxes. The rate is generally 1% on the earned income tax. That's one type of Pennsylvania tax. Then they also have the local service tax, which is about $52 per employee per year. And they also have a Pennsylvania unemployment tax, which is a portion that the employee pays towards unemployment compensation, which we'll discuss later. But that's just 3 taxes for one local area. Ohio also has a lot of taxes, a lot of taxing jurisdictions, up to 900. And you also must know where the employee lives or works in order to get those withheld correctly. There are some states that have an occupational tax. And occupational tax is where the employer is mandated to withhold these taxes. If not, at the year end, the employer can become liable for these taxes. States such as Kentucky, Delaware, and West Virginia have an occupational tax. So you should really be careful to know if your employees are working in those locations. Otherwise, you will become liable later. We had an incident where an employer was located in Denver, Colorado, and the business was licensed to do business there. After 3 years of paying the local taxes to Denver, Glendale, Colorado came to the employer and asked why they weren't paying taxes to Glendale. And after realizing the client was actually in Glendale, they were just on the line. And so when they called Denver to get a refund, Denver agreed that, yes, you were not supposed to be paying taxes to us, you should have been paying to Glendale, but they still collected the money from the client. We had to go through a lot of work to get the refund from Denver to pay to Glendale. Denver was not easy to work with. They wanted lots of documentation to show that the taxes were paid. They wanted W-2s, etc. And eventually, after months of working with Denver, they finally gave the refund to the client in order for them to pay the correct local taxes to Glendale, Colorado. So even if you think you're in a specific work location, it doesn't hurt to call and make sure that you have the correct taxing jurisdiction so you don't run into a situation like this. And there are other types of local taxes that other types of taxes that we lump into as local taxes, such as disability tax. Rhode Island and New Jersey have a disability tax, and this funds the disability program in these states. So if an employee goes out on disability leave, they would have funds to cover their disability. What are unemployment taxes? This is a tax that funds the unemployment system. If an employee is out of a job through no fault of their own, the state will fund them in order to help them during this transition. The unemployment tax is paid by the employer quarterly to the state, and on that tax return is listed the employee's information such as name, social security number, and amount of wages for each quarter. Then the tax is paid based on a tax rate given to the employer by the state. What state do you report these taxes to? Generally, it is where the employee works. So if they work in Maryland and live in Virginia, you would report the unemployment taxes to Maryland, not Virginia where they live, but where they work in Maryland. If they're a salesperson and work in many states, you would choose the state where they work the most frequently. And if there's no specific place that they go to often, then you would just pay based on where they live. How does the state determine the tax rate? The tax rate is determined by many things. For example, the more unemployment claims made against your entity, the higher your rate will climb. It is important to monitor your claims for this reason. The claims are sent by the state if an employee goes out on unemployment, and it's important to know if you should fight these claims, because fighting these claims will help your rate in the end. And the calculation by the state is done typically by benefit claims to your taxable wages. If your claims to your wages are very high, your rate will be negatively affected. A second way your rate can be affected is if you do not pay your taxes on time. The state can add a penalty rate. Some states will add a 3% penalty to your tax rate. Next, the federal government has an unemployment program as well, called FUTA, or Federal Unemployment Tax. This fund helps supplement the state fund. The FUTA tax rate is 0.6%, or $42 per employee per year. However, if you do not pay the state unemployment taxes timely, the IRS will be notified. In turn, your FUTA rate will be affected. The IRS will give you a penalty rate for that next year, or for that year actually, and the rate they will give you is 6% instead of the 0.6%. That is a $378 per employee difference that you will pay to the federal unemployment program. Also, if the states have to borrow money from the FUTA program, the federal government will charge an additional FUTA tax back to the employer for the loan that they had to take. In 2013, the economy was doing poorly, and 19 states had to borrow money from the federal program to fund their unemployment claims. Then in turn, employers in those states had to pay a higher FUTA rate to repay the loans given from the federal government to the state unemployment program. In 2016, California and Connecticut both had a loan due to the government, and the employers had to pay an additional FUTA rate of 1.8% and 2.4%. So if the economy is doing poorly, then the employers have to suffer as well. Lastly, to save money, it is really important to review your annual tax rate notices. Each year, the state will review your rate and your claims, because your calculation of your rate is based on your claims. And so when you get this notice in the mail, you should review it, because they are not always accurate in their calculations. For example, on our Maryland tax rate notice, the state had entered our taxable wages as $1 million, when in fact it should have been $7 million. This caused our benefit charges to taxable wage ratio to be very much higher, increasing our rate by 1.5%. And that would have cost us $127 extra per employee. I had to send an appeal letter within 15 days of receiving that notice. Otherwise, that rate would have stuck with us. And after I sent in the appeal, it took multiple phone calls and follow-up to make sure that they gave us the correct rate. However, the next year they did the same thing. They put the wrong wages in, and I had to fight all over again. So even if you think you've resolved an issue, a lot of times the state will go back and make the same mistake. So it's very important to pay attention to your notices, because this will save you money in the end. Next, I'm going to talk about federal taxes. What are federal taxes? This tax consists of federal withholding, Social Security, and Medicare taxes. Social Security and Medicare taxes are calculated using a flat tax rate. And the federal taxes is based on a tax table from the IRS. And the amount is set up at the employee level for using the W-4 form. And again, this tax form is changing significantly in 2020. Instead of choosing number of exemption on this form, a dollar amount is selected instead. And all companies and employees will need to get a better understanding of this form. Next, the federal taxes are all reconciled on a form called a 941. This is sent in quarterly. The 941 reconciles your tax payments to your liabilities. It is important to pay your taxes on time with the IRS. If your 941 amount reaches $100,000, that payment must be deposited the next day. The penalty on a late payment with the IRS can be anywhere from 2 to 15% of the tax due. And on $100,000, if you're late, that can be $2,000 to $10,000 penalty. I had a situation where an employer got a notice that they overpaid their 941 taxes by $40,000, and the IRS was going to send them a refund check. I called the IRS to find out why they sent that notice, and found out they had not received the 941 yet. The 941 is important to the IRS because that's how they apply your payments. If they do not have a 941, they do not know how to apply your payments, and they will send you a refund check for that quarter. So once I found out that they did not have the 941, I sent that in, and the employer did not take the refund. But I had one employer who got a $8,000 check from the IRS, and they deposited that check. Then the client called and asked why he got a check for $8,000. And after I called the IRS, I found out that the 941 I had sent in, the IRS had inputted the wrong amount for the Social Security wages. They entered $7,900 instead of $79,000. This caused a calculation error, and in turn, they sent an $8,000 check to the employer. And I asked the IRS if they could just fix it because they input the number wrong, but they told me I had to amend the 941. And then in addition, the client had to send the $8,000 check back to the IRS, or we had to fund back that $8,000. They had already deposited the check, and the IRS ended up penalizing them for a late payment, even though the IRS should have never sent them a refund in the first place. And after some time, we were able to get that penalty removed, but the IRS did not acknowledge their error at all. So it's important to review your notices and not deposit any checks from the IRS unless if you are expecting one. And if you do are not expecting one and it should be refunded, you send the check back, because otherwise the IRS will penalize you, even if it's their fault. And at the end of the year, you will reconcile your W-2s to the 941. You, just like the states, you upload your W-2s to the Social Security Administration, and those W-2s should match your quarterly 941s or your tax payments made to the IRS. If these do not match, you will get a notice from the IRS. So we'll talk about W-2s. W-2s are a summary of your earnings for the year and your withholdings for that year as well. It is a year of work put onto one form. It is important for the information that goes on the W-2s to be accurate, because the IRS can penalize you for inaccurate information. And they also should be uploaded by January 31st of the year. If not, you can get up to $50 per W-2 penalty for not submitting those W-2s on time. That's a maximum penalty of $536,000. And since all the W-2s are uploaded onto one file, so you can have like 10,000 W-2s on a file, if you do not get confirmation for your file you upload, or you make some mistake, you can get a penalty per line item because all W-2s are on one file, so one mistake can cost you a lot of money. It's very important to make sure you get that confirmation by January 31st. And again, the IRS, or Social Security Administration, changed their deadline in 2015 from February 28th to January 31st, putting more pressure on the employer to get this to all the data to the Social Security Administration earlier. In addition, the Social Security Administration has recently added a system for you to check employee Social Security numbers. They want you to verify that the Social Security numbers match to employees' names. Since they want the W-2s to be more accurate, this is one more way that they're expecting employers to do this. And it just adds another layer of compliance and responsibility to the employer. Okay, now I will discuss new taxes. Each year it seems that new taxes are always coming up. For example, in 2018, in New Jersey, they discussed adding a Jersey City tax. And at the end of 2018, they passed the law, and in January 2019, employers were expected to start withholding this tax on the employees that worked in Jersey City. Massachusetts added an EMAC supplemental tax. This is an employer medical assistance contribution. This was created in 2018, and it is a temporary program which the employer pays a 5% tax on employees' wages who are on the Massachusetts subsidized health plan. And this is only for employers that have more than 5 employees. Oregon also created a tax in 2018 called the statewide transit tax. And lastly, we have the paid family medical leave tax. 4 states now are imposing this tax. That's DC, Massachusetts, New York, and Washington. This will help cover employees if they have a family medical leave situation. And it seems each year more and more states are jumping on board with this tax. And each state has a different way to pay the tax. So it's really important for employers to be on top of any new tax laws so that you can apply the taxes to your employees' paychecks. Here are some top things to remember from this presentation. One thing to remember is know where your employees live and work. As you have learned, this is really important. It determines all sorts of things such as the state taxes, local taxes, and unemployment taxes. It's important to know where they live and work. Also, it's important to understand the type of tax returns that you need to file and when the payments are due. This is important in order to avoid unnecessary notices. Also, you should monitor for new regulations for the states that you are in. Be sure to sign up for email alerts from the states to know of any changes that come through. Also, make sure that you inspect all notices that you receive. Do not just trust that the state has sent you correct information. Oftentimes, you can fight these notices or find out that they have not posted something properly. And even if you do make a mistake, the states will oftentimes give you a one-time penalty waiver. So be sure to inspect your notices. You can save money in the end. As you can see, there are a variety of payroll taxes. If you are an employer in multiple states, it can be very complicated to keep up with so many tax types and concentrate on running your business. A software can help determine what taxes get withheld, but it is important to know what to expect so that you can ensure accuracy in case something goes wrong in the system. In addition, making and filing the tax returns can be done with the help of the software, but knowing the consequences of filing incorrectly or making a late payment is important. After 18 years of experience, I have seen the state agencies and IRS go through many changes, and I'm constantly learning and improving how things are done. Now I will open up the floor for any questions that you may have. You can use the chat function, and you can unmute yourself. Also, if you have any questions, you can contact us at info@excelhr.com.